Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. And despite the market being at all-time highs, we have a lot of interesting insights to unpack today. Number one, inflation concerns shift rate expectations higher. We've had some mixed data recently, but why that a little bit elevated inflation continues to cause rate expectations to move higher. Number two, technology, the tech sector specifically, valuation compression continues. That is the story or one of the main themes so far of 2026 is that rotation out of tech, large cap tech. And then finally, investors are buying quite a lot of hedges. Some of it is related to around the risk off attitude with technology stocks, software stocks especially. But overall, we are seeing a massive increase in put buying. And if you look at the prices of put options versus call, that skew is very significant. And there's a lot of demand for downside protection. All right. Inflation concerns are shifting rate expectations higher. We had the government shutdown during the fourth quarter that caused us to miss an October report. But we're back to somewhat normalcy, even though we're going through another partial shutdown and we're still trying to get back to normal economic updates. But when you take a look at inflation, CPI came in at 3% or 2.4% rather, but core PCE came in at 3% in December, the most recently released report. And remember, the Fed's long-term target is 2%. Let's take a look at a chart that compares Fed fund rate expectations for the end of 2026 by Fed fund futures. So these are market participant bets compared with that PCA core. So on the chart here in the green, you see the core year over year. That is the Fed's preferred measure of inflation at 3%. That's important because that is a full 1% higher than what the Fed's long-term target is. And you're seeing expectations for Fed cuts diminish over the last several months. You can see that in the orange line. That is the Fed funds rate expected rate by the end of the year. Remember, it's at around that 3.75% top range now. It's expected to be around 3.2% by the end of the year. It's around two cuts. But if you look back just a few months ago, that was pricing in three cuts. So market is resetting those expectations as inflation continues to linger. And you even observed on the Fed meeting minutes from the February meeting that several Fed members were somewhat concerned about this inflation and actually talked about potential risk of increasing rates. So Fed expectations no longer in that three camp, potentially two going forward. And remember, Kevin Warsh takes over as the head, or the chairman rather, assuming all goes well with his committee, in May from Powell. So passing that baton, nobody expects any cuts until at least that transition in May. So tech sector valuations continue to compress. This is the NASDAQ 100, a tech heavy, large cap growth heavy forward 12-month price to earnings ratio. And you can see at the October peak, they had valuations of 28. They have compressed about 11% during this decline in tech stocks, specifically a lot of those large cap growth names. So compression is real. There's a combination of concern around how much AI will disrupt tech adjacent or AI adjacent firms. There's also this lingering concern about the amount of spending that companies are doing, the amount of debt that they're raising related to AI. So all of that concern, we're starting to see a rotation out of tech. Valuations are compressing. They're still slightly elevated relative to historical norms. For example, the 10-year average forward price to earnings ratio is at 23.8. So at 25, it's still slightly expensive, but nowhere near like it was. And we're seeing this compression where some tech stocks, specific industries, have actually reached bear market territory. Even though the overall market is still near an all-time high, we're seeing a broadening and a rotation out of these large cap growth names in a way that we haven't seen for the last few years. Now, because of some of the fear that I just talked about, you were seeing that reflected in people wanting to buy downside protection. This chart is the SIBO put volume to call volume. Remember, somebody who buys a put purchases it for downside protection. Somebody who buys a call is doing that for potential upside. So that ratio goes higher when you see more put than call volume. And as you can see, we actually are reaching up near that zero point 0.7 for the first time since April of 2025. That is notable because April was when we were midst of the tariff volatility and uncertainty where the stock market nearly reached bear market territory and volatility was extremely high. So market in a much better place now, but you're seeing extreme demand for put hedges right now, as reflected by this ratio. If you look at the skew, the price of put options 10% out of the money compared to call options 10% out of the money, put options are more expensive than call options by a very significant amount. In fact, more expensive than about 90% of the times over the past 2 and 3 years, respectively. So there are a lot of investors right now that are willing to pay increased prices for downside protection. Remember, Warren Buffett always says that be greedy when most are fearful. And hey, most are fearful right now. So one thing people aren't familiar or are fearful about, rather, is spending on AI. And there's a lot of talk and debate in the industry around energy consumption. If you look at the amount of energy that the technology sector and AI adjacent demand is using, we have 8% projected by 2030. Right now, it's 2% of global electricity is used. In fact, ChatGPT, one query or prompt rather, is using 10 times the energy of a Google search. So this is going to be something to monitor, right? You have these massive data center warehouses around the nation in rural areas that are taking up a lot of land, using a lot of resources. Energy efficiency around electricity or alternative sources of energy is probably going to be one of the most necessary advancements that we as a people are going to have to make over the next 10 to 20 years. And I think that's going to be a focus for companies and people that are able to make advancements in that area. You're going to see some really, really large companies be developed over the next couple decades that are able to achieve really meaningful advances in that industry. With that, I want to thank everyone for watching, and I'll see you next time.